Hello there. Welcome back to Financial Accounting in 5. This video, we're going to look at the calculation of accounting ratios or financial indicator. So this is the question that we have according to our question paper is question 6, and it reads the following information was obtained on 3rd August from the financial records of conventional retailers for the previous 2 years. So we are given a list of balances there for 2019 and 2020, but you know that 2019 is the previous year, and then the current year becomes our 2020. And then we are given included in the above are the following. So we also have our data control and trading inventory, and we know that data control and trading inventory is part of our current assets. So we go down, we are given other information that we need to go through before you answer the question. The first item, which is A, reads the business and maintains a profit markup of 30%, and then B, trade receivables get 30 days credit, and the business allowed 60 days credit from its trade payables. Then on the last part, C, good inventory turnover rate of similar interest in South Africa is 4 times per year. So on the question part, the first part of the question, 6.1, choose the correct answers using the financial information of commercial retailers for the year ended on 30 August 2020. It reads cash sales amounted to, which is 6.1.1. So the question requires us to calculate cash sales, so we can just go refer back to the information given in the question and try to see how can we calculate our cash sales. But if you come here, we have got our sales figure, which means this figure that we are given. Remember, we are calculating for the current year, which is our 2020. So we are saying for sales, we are going to use the figure for 1,352,000, and we are told that 20% is cash. So basically, we are just going to say 20% of the total sales figure that we are given is 1,352,000. So we can just try to calculate there so that we can get the actual answer. So we are saying 20%, remember 20%, we are saying 20 over 100, and then we multiply by 1,352,000 over 1. Let's calculate that and see what do we get. So if you say 0.2, 20% is a decimal, becomes 0.2, and then we multiply by 1,352,000. You're going to get 270,400. So your answer is 270,400. So this is what we get check now. If we have got that answer in our responses, I would say that we are having it on B. So it means the answer that we have there is B. So you can just indicate your B as the correct answer. Then you move on to the next question, 6.1.2, and it reads a cash flow problem can arise when A, trade receivables paid too late, which is very correct. When trade receivables paid, we are going to delay to get our money. So we are obviously going to have some cash problems in our business, which is correct. Let's look at the next one. Inventory turnover rate increase. Remember, when inventory turnover increases, it means we are selling our goods at a faster rate. Goods are coming in and going out at a faster rate, which means we are getting cash quickly. So we're not going to have any cash problems. Then we go to our C, the business pays its trade payables too early. Remember, when we are paying our trade payables, it means it's an outflow of money. But as we pay early, we are going to avoid some expenses like interest on our accounts of late payments. So it's not going to lead us to cash problems. We are supposed to pay, but we are paying early and avoiding paying more. So it's not going to lead us to cash problem. Unless we pay late, it means it's going to attract some penalties like interest. So this one is not correct. Then we go to D. The business pays its trade payables too late. When the business pays its trade payables too late, it can lead to it might lead to cash problems because it might attract some interest that we need to pay, and we're going to pay more. But you see that the one which is very very immediate is that of trade receivables are paying too late. because because this money that we are paying is trade payables. It's a money, it's an obligation that we have to pay those trade payables. So you see that the most correct one, according to the responses that we are given, is A. So we have got A as the answer that we have there. Then we can move on to the next page to see what's the next question that we have. So coming here, we are now coming to 6.3. 6.1.3 and trying to see what we have. It says the firm had a rate of inventory turnover of 9 times for the year. This shows that it's obviously there are similar businesses in terms of inventory turnover of similar businesses that were given in the question. So we can just try to refer back and see what's the rate for similar businesses. So if you come here, you would see that we're given that good inventory turnover rate of similar industries in South Africa is 4 times per year. So the similar business has got 4 times per year, and then this one is 9 times, which is more than of similar business, which means we are turning over our rate more than a similar business, which means our inventory turnover is better. So we look at the responses that we are given there. You'd see that A saying is the same as similar business in South Africa, which is not correct. They are not the same. Is worse than similar business in South Africa, which is not correct. We are saying it's better. We are saying that C is the most correct answer that we have, which is saying is better than similar business in South Africa. So we've got C. Then we go to 6.1.4. The current ratio should be at least, we know that the current ratio should be at least 2:1. Then you'll see that it's on D. So D is the correct answer that we have there. 6.1.5, the amount of cash and cash equivalent is equal to. So we need to go back and calculate the amount of cash and cash equivalent. So if you come here, let's try to see in the question, how can we calculate the amount of cash and cash equivalents. So given the information that we are given there, you'll see that we are given cash and cash equivalents is part of our current assets. So if you check there, we are not given the figure for cash and cash equivalents, but we are given the figure for current assets there. For the current period was 540,000. So we are going to say 540,000. And we know that components of this current assets were given the year. Debtors we are given given is 250,000, then inventory given is 120,000. But we know that the other part is going to be cash and cash equivalent. So you're just going to say 440,000 minus 250,000. Then we subtract again 120,000. So let's try to see what we get by calculating it like that. We are saying 540,000. And then we subtract 250,000, and then we subtract your 120,000, and then we are going to get you 170,000. So here we are saying 170,000. So this is the answer that we are going to try to check other section whether we have 170,000. We are seeing that we are having it at C. So C is the correct answer that we have there. So we can just indicate our C. So this is what we have in terms of the multiple choice section. So let's try to see the next question that we have. We are now on 6.2, which is saying calculate the following ratios and percentages of organized retailers for the year 2020. So on 6.2.1, we're given rate of return on owner's equity. So we go there and try to obviously we need the formula first. We need the formula first. So let's just try to see. So we are saying on this question, which is our 6.2.1. So we are saying 6.2.1, and we are saying the formula of rate of return on owner's equity, rate of return on owner's equity. We are having it as equal to The formula that we use to calculate is equal to net profit over uh, average capital. Then the answer that we get we multiply by 100 over 1. So obviously our net profit, we're going to get it in the question. So let's just try to see according to the figures that are given, can we be able to identify the figure for net profit? So net profit we're given it there is in the current year is 98,600. So basically we are saying equal to 98,600. Obviously over. Then we check the figure for average capital. So let's try to see in terms of average capital. Average capital, obviously, we are saying the capital of the current period plus capital of the previous period, then we divide by 2 to get the average. So we are saying capital is here, we are saying 342,000 plus 351,000, then we divide by 2. So we just come here and do that, 351,000. We are saying 351,000, and then we add our 342,000. So the answer that we are getting there, the total answer we divide by 2 still. So we can just say half, then we get the average. Then obviously, here we are going to multiply by 100 over 1. So we calculate it like that to see that the figure that we are going to get there by saying 351,000 plus 342,000 divided by 2, you're going to get 346,500. So to simplify it further, there it becomes 98,600 over the average, which is 346,500. And obviously, you are going to multiply it by 100 over 1. And then we'll try to see the percentage that we are going to get there. You calculate it, you see that the answer that you are supposed to get there is going to be 24. We can just try to verify that calculation by saying 98,600, and then you divide by 346,500. And you're going to get 28. The figure that you are supposed to get there is 28, which is 0.28455, and multiply by 100, you're going to be able to get your 28.4559. And obviously, we have to round it off. If you round it off to 2 decimal places, that is, we are checking our 5 here, which is going to change our 5 to become 6. So it becomes your 28.46%. So this is what we have in the calculation of rate of return on owner's equity. So this is what we have. So we can just try to go back and see in terms of the next question that we have. So on the next question, that is our 6.2, we are going to calculate our individual turnover rate. And obviously, we need to first put down the formula of individual turnover rate. So we are saying 6.2.2, 6.2.2. We are saying individual turnover rate, it's equal to our cost of sales, and then obviously we divide by average stock. And then this is what we have. So the answer that we're going to get, we leave it in the form of times, number of times. So we check the cost of sales figure according to the information given. Let's just try to see if we are given the figure for cost of sales. So you see that we are given gross profit, net profit. We don't have cost of sales for the given sales. So obviously, we know that to get our gross profit, we know that gross profit is equals to sales minus your cost of sales. So obviously, the figure that we want is not cost of sales. So if you make cost of sales the same as formula there, it's going to be sales minus your gross profit. So this is exactly how we are going to get our cost of sales. We're just going to see our sales figure minus gross profit figure. So we go there. Obviously, we are using the current for the current year, which is 2020. So our sales figure for 2020 is 1,352,000. 1,352,000. Then we subtract the gross profit figure, which is here, which is 360,000. And the figure that we are going to get there is going to be 992,000. So this is the figure for your cost of sales. So we go there and put our numerator is 992,000. So we are saying it's equal to 992,000. And then we divide by average stock. Average stock, we are saying opening stock plus closing stock, and then we divide by 2. So we go to the stock period, stock figure, which is the inventory figure for the current period plus for the last period. So for average stock, we are saying 120,000 plus 90,000, and then we divide by 2. So that's how we are going to get your average stock. So you go there. So we are saying 120,000. The other ways we are saying which is the average 109, let's just see 90,000 plus 120,000. So here we can just maybe try to remove that one. So we are saying 90,000 plus 120,000. So we simplified further, it becomes 992,000 divided by, if you say half of 90,000 plus 120,000, and the figure that we are supposed to get there is 105,000. And simplified further, we see that for two decimal places, you're going to get it as 9.5 times. So remember, even though turnover, you are supposed to leave it as times. So we put 9.5, 9.45 times. So on the next ratio, we are going to calculate the current ratio. According to the question, the next ratio is going to be the current ratio. And obviously, we need to put down the formula first. And the formula for our current ratio, we are going to say our current assets is to current liabilities. Current assets, current liabilities. So obviously, we have to leave this current liabilities as 1. So to leave it as 1, we are going to divide by current liabilities both sides. So this is the basic formula that you can, or the calculation part that when you divide by current liabilities both sides, we're going to leave the right-hand side is 1. And then we just check the figures for current assets and current liabilities in the question that we have there. Come back here, you see that our current asset figure, we have got 540,000. Then current liabilities, we've got 310. So 540 is to 310. So you just come here. We are saying 540,000 divided by current liability which is 310,000. S2, 310,000 current liabilities divided by 310,000. Obviously, this other side is going to remain as 1. We can try to. So we are saying, if you say 310,000 into 540,000, and the figure that we are going to get to two decimal places is going to be 1.74. Just to 1. So this side is going to 310,000 into 310,000, we get you 1. So this is going to be your current ratio. So on the last part of our question, we are going to calculate the solvency ratio. Solvency ratio. So let's just try to see. For all the solvency ratio, the formula that we are going to use is total assets is to total liabilities. So we're going to add all the assets that we have, and then we get the total. And then for total liabilities, we also add the total liability that we have in the person and present it as a ratio. So let's just try to see in terms of total assets first. For the current year, we know that we've got non-current assets here. So let's just say our non-current assets in this column, we have got 120,000, and then we add our current assets. Our current assets, delete that, which is 540. So basically, to get your total assets, you need to say non-current assets plus current assets. So in this case, we have got 540,000 being your non-current, and then we add your 120. So exactly that. Let's just try to go and present it as that. We are saying 520 plus 120. So we've got 540. Sorry, 540 there. So we can just try to. So we are saying 540,000, and then we add 120. So this one will give us the total of total assets. Then we say S2, our total liabilities. We go again to check what figures we have in terms of total liabilities. We are here. We are seeing that non-current liabilities. Non-current liabilities we have is here is 50,000. Then current liabilities we are given it here is 310. So 50,000 plus 310. So we go there. So we are saying 50,000 plus 310,000. So we add here is 540 plus 140,000 plus 110,000. Total that we're going to get is 600. 660,000. S2, 50,000 plus 310,000, you get 360,000. So this is what we have. So obviously, this side again, you're going to leave it as 1 for total liability. So we divide by total liabilities both sides, whereby we are saying over 360. And then here again over 360,000. So we divide it, other than we are going to get there, that becomes our solvency ratio. So when we divide there, 360,000 into 660,000, two decimal places, you get 1.83. Yes, to 360,000 into 360,000, we're going to get your 1. So this is basically what we have in terms of your solvency ratio. So this is what we guys are going to do in this video. Let's subscribe and share. Let's share the link to our colleagues who are doing financial accounting at 5. Let's stay tuned for more videos to come as we prepare for final exam. As for this video, I'm signing out. We'll meet again in the next video.